Okay, picture printing negative 73% gross margins and taking a massive revenue hit. But somehow you also book a record $31 million defense backlog and plan a 400-machine gigafactory empire? That is exactly the paradox we are looking at with Velo3D today. Welcome to Earnings Unscripted. It is March 24th, 2026, and we are unpacking Velo3D's fourth quarter 2025 results. And look, before Miro starts tearing apart the balance sheet, quick reminder that this podcast is just our personal opinions, definitely not financial advice.
Which is good because this quarter's print looks like a controlled demolition. I mean, you see that headline gross margin drop to negative 73.6%, and your first instinct is to panic.
Right, because last quarter they were actually positive at 3.2%. That is an absolute freefall.
It is an optical disaster, but they are essentially biting the bullet. Management booked a one-time $7 million inventory obsolescence write-down. They are basically flushing dead inventory now so they can start 2026 with a clean slate. It hurts, but it is highly strategic.
A $7 million Band-Aid rip, got it. And the top line felt it too. Total revenue came in at $9.4 million, which is, it is down 31% sequentially from Q3. And their net loss worsened to $1.03 a share.
Yeah, but that revenue drop is not just a demand vanishing act. They got hit by timing delays tied to the Q4 government shutdown. When your core business is selling advanced metal 3D printers to the Department of Defense, budget standoffs in Washington directly hit your quarterly targets.
Which completely explains the absolute whiplash in the stock price. Because if you held the stock during the actual fourth quarter, it was a rocket ship. It appreciated over 350% to close the period near $14.50.
Exactly. The quarterly momentum was massive, but earnings days are entirely different animals. They actually closed the regular session today up around $13.50. Then the release hit at 4 p.m., and the market absolutely hated the delayed profitability timeline.
The after-hours sell-off was immediate.
Yeah, down about 9%. It ended the extended session around 12:30. Investors just have zero patience right now. Management officially pushed their target for positive EBITDA from the first half of 2026 into the second half of 2026.
Meaning more cash burn in the meantime. But we really need to talk about what they're burning cash to build. They're pivoting away from just selling hardware to being the quote-unquote AWS of manufacturing data. Plus, they announced this master plan to roll out 400 of their own production systems over the next decade.
That's the real narrative pivot here. They want to sell manufacturing capacity directly. And the demand side of that equation is actually holding up. That $31 million backlog we mentioned is a company record, up roughly 48% from just last quarter.
So they're quite literally tearing down the old business model just to pour the foundation for a much bigger one. All right, let's get into the details on how they actually plan to fund this entire fleet.
It is a massive, capital-intensive bet. You do not just snap your fingers and spin up 400 advanced robotic metal printers. That takes serious liquidity. And they actually pulled a rather clever maneuver on the balance sheet to set this up.
Okay, break that down for me, because right now they have, $39 million in cash?
Right. They ended Q3 with roughly $12 million. 11.8. Then they secured a $30 million private placement in the fourth quarter. But the real trick happened just after the quarter closed. In early Q1, they took $15 million of outstanding debt and converted it to equity. Acting CFO Bernie Chung pointed out this reduced their outstanding debt by roughly 60%.
Hold on, so they just swapped debt for shares, which dilutes the current equity holders. Shareholders took a hit so the company could clean up the books.
Yes, exactly. But it frees up their working capital. You cannot build a 100-machine fleet in California, which is phase 1, by the way, if you are choking on debt covenants. And they are going to burn through cash fast. Their CapEx guidance for 2026 alone is $40 to $50 million.
Jeez, $50 million just on expanding their own factories? But management said they wanted to avoid more dilution, did they not?
They did. The 8K clearly states they expect to raise additional capital in the near term, but they want to lean heavily on asset-backed debt and government grants. They are basically planning to use the physical 3D printers as collateral for loans.
So they're taking out mortgages on the hardware? That is actually fascinating. They stopped selling the printers and just rent out the manufacturing capacity as a service?
Well, yes, it is what they call rapid production solutions, and it fundamentally changes their valuation model. Hardware vendors trade at, they usually get terrible multiples, but software and data ecosystems get massive premiums. And the CEO, Arun Jeldi, was very explicit about this transition on the call.
What did he actually say?
He literally said, quote, "We have a strong focus on the business for next 5 years, where VELO will be the AWS of data and analytics company." He sees the physical printers as just the compute nodes. The real value is the localized capacity and the data.
Right, which connects perfectly to what they're doing with the defense sector, like the Army ground vehicle qualification.
Exactly. They became the first additive manufacturing vendor qualified for the U.S. Army Ground Vehicle Center, and they did the entire qualification in under 2 weeks.
Wow! 2 weeks in defense procurement time is basically the speed of light. That is normally a bureaucratic nightmare that takes months. So if they own the machines and the data, the Army just pings them when a tank needs a custom part, and VELO prints it right on site.
And they are not stopping there. To make that ecosystem truly bulletproof, you have to control the raw materials. Jeldi mentioned targeted M&A for 2026, specifically looking at vertical integration, buying up metal powder and feedstock producers. He said on the call, quote, "I always believe that if you can control your feedstock supply chain, you have a tremendous value as a company."
Oh, I love that. So you're not waiting on a cargo ship full of specialized titanium dust from across the globe. You own the powder, you own the printers, you own the data.
It is an entirely closed loop. If they pull it off, it is brilliant. They insulate themselves from global shipping bottlenecks entirely. But, and this is the skeptic in me talking, building a domestic gigafactory ecosystem while targeting software-level margins requires flawless execution. And their track record on, say, inventory management just cost them $7 million.
Fair point. The vision is undeniably huge, but the runway is still pretty bumpy. So where does this leave their actual trajectory heading into the rest of the year?
It leaves them walking a very expensive tightrope. The full year guidance for 2026 is actually quite aggressive. They are projecting 60 to 70 million in revenue, and they expect gross margins to push past 30% in the second half of the year.
Which, conveniently, is exactly when they claim they will finally hit positive EBITDA.
Right, but to get there, they have to survive this massive CapEx phase. $40 to $50 million of heavy spending. Jeldi actually said on the call, quote, "We are moving decisively and expect to raise additional capital to move faster."
Move faster usually just means burn faster in this market. And their plan relies entirely on the Department of Defense not having another budget standoff, right?
Exactly. That is the core vulnerability here. The technology is proven, the backlog is real, but the customer base is politically fragile. They already blame the Q4 government shutdown for missing revenue this time around. If you peg your entire 400-machine master plan to defense spending, you are essentially outsourcing your cash flow timing to Washington gridlock.
Yeah, that is a heavy anchor. But I was going to say, I do kind of respect the sheer audacity of the vision. It is not just another tech firm optimizing algorithms. They are actively trying to reindustrialize American defense manufacturing. If they actually cross that bridge to 2027 without drowning in debt, it is a masterstroke.
Oh, if. That is the key word. I think the next 2 quarters are a pure test of execution. Investors are going to watch the balance sheet like hawks. We need to see them actually secure this non-dilutive asset-backed debt they keep teasing. Because if they start diluting equity again just to build printers, the market will completely lose faith.
Oh, absolutely. You cannot promise smart debt and then deliver shareholder dilution. Well, it's a massive, incredibly bold vision just built on a very fragile bridge of capital.
Yeah, let us see if the bridge holds.
We will certainly be watching. All right, that is going to do it for our dive into Velo3D today. Thank you so much for listening, and we will catch you after the next. If you like having these earnings drops just naturally show up in your feed, you might want to give the show a follow. We actually put these episodes together using a bit of AI to sift through those dense financial filings, which really just helps us focus on the actual story. So if there's a specific ticker you want us to dig into next, definitely shoot a note over to earningsunscripted@datamadness.ca or hit the X link in the show notes. Thanks for listening and take care.
See you next time.